all things cement pricing, especially there. Well, Tech Mahindra is the company we are focused on. Weak set of numbers in the fourth quarter, and as promised, the management is with us. My colleague Reema caught up with Tech Mahindra's Managing Director and CEO, CP Gurnani, and Chief Financial Officer, Rohit Anand. Began by asking them about the quarter gone by and how they see margin trends going ahead. Listen.
There is a drop in margins, but to me it is all temporary. I think you would see an upward tick because our investments will yield better results as we get into the next 2 quarters. So overall, I can only say, good time to invest, and Tech Mahindra is investing.
Rohit, can you explain this 80 basis points margin drop?
On margins, the headline number shows 80 basis point reduction, but there's a close to 60 basis point headwind which you saw from FX. Last quarter, if you remember, we saw a similar tailwind on FX that got reversed this time, it's the opposite side. So if you normalize for that, at a constant currency, it's just a 20 basis point drop. And when you correlate that with direct cost versus SG&A, you'll see our direct cost is down and our gross margin is up, adjusted for currency. And that got offsetted on a CC basis by SG&A to the investments that CP is saying that we continue to invest. It's very easy to pause long-term investments and within the organization, but we decided to continue with that, and some normalization of costs that happen in 4Q, which will ease down as we move into 1Q. So that was main of the reason. It's driven by SG&A, then really the direct cost, which has given us the benefit this time.
What's the guidance on margins, Rohit? Currently 11.2%. Where do you see it headed in the next 2 quarters?
As CP mentioned, I think we, of course, as a company, don't give a guidance formally and a policy, but as he mentioned that we'll continue to invest, and based on those investments, we see next year overall the margin heading positively, and we have multiple levers that we are continuing to work on. Basis all that, our view is that will move in the positive direction from where it is right now.
CP, can you talk about the deal wins? The deal wins were in a run rate of $700 million to $1 billion. It's fallen to $582 million. What's happening on the macro front in terms of the deal wins, the deal pipelines, the slowdown, the cutback in discretionary spending, and across which verticals?
No, I would not read too much into $600 to $700 million deal win, because we all know that the funnels are good. Overall, the IT demand is still very, very high, and particularly for us, because we are also invested in network services, we are also into the content creativity side through XDS. So I think it is just a quarterly dip, but overall on an annual basis, I'm very confident that the previous year, which is FY23 closing, we had done $3 billion. Since we do not give indication, but I can only tell you is that it will be far better than $3 billion in FY24.
Okay, so FY24 deal wins to be better than FY23 deal wins of $3 billion. Rohit, any deal cancellations or deferrals?
No, we haven't seen any specific cancellations. In terms of decision making, there is a slight delay in finalizing and closing deals, which is reflective in some of these differences that you see, but it's not material right now. So hence, overall, as the broader context CP articulated, our pipeline continues to be robust, and the discussions with customers are moving in the right directions, which gives us a view overall from a positive standpoint on FY24.
CP, retail has seen a 10% drop sequentially. Can you explain what happened?
I think retail is clearly a sector which is, it's a weakness in consumer demand right now. They all had a good Thanksgiving. They all had a good Christmas, and after that there is a clearly, and we, to be honest, I mean, I expect the slowdown to continue in retail But at the same time, as I said, we are diversified. If retail slows down, we will be focusing more on healthcare, or we will be focusing more on insurance. I mean, so there will always be a realignment, but I do believe that retail is one of the biggest consumers of technology, and they will come back.
Rohit, one final question.
And some of it is Reema expected, right? Because it's a seasonality quarter for us from a retail standpoint. So it was expected for that to go down. But as CP mentioned, that continues to be a pressure point based on the overall segment dynamics right now.
Any other pressure points apart from retail that you see in the environment currently? And if you could just quickly explain that impairment charge that you've taken of more than 200 crores.
Yeah, so impairment charge is one of our older platforms that we had, where the carrying value of the investment based on the future cash flow was not substantiated when we reviewed it as a part of our annual cycle. And based on that, we've taken the right prudent call from an accounting standpoint and impaired that value to reflect the future cash flow of that asset. So that's what's flown in through from a one-off impairment charge this time.
That is the Tech Mahindra management. Let's find out what the outlook is from an